No, I think Vish raised some very correct points about the challenges of actually making money in this market. And our challenge is not just making money in bull markets, but you have to work through cycles to be able to make money through cycles and confront some of these challenges such as corporate governance and others that we face. And I think over time, the GP community overall in India has to think out of the box, has to look at different paradigms in order to give alpha to investors. It's no longer okay just to give the same returns as public markets, because then LPs are going to beat you over the head about paying you 2 and 20 about this. And I think we're beginning to see some of that right now. So for example, one thing I think that is clearly a trend in India, and I think it's learnings from overseas markets, is that PE funds are taking larger stakes in the companies they invest in, hence have a greater degree of influence, and hence through that influence are bringing in operating capability into the company. So not just bringing in a CFO sometimes into the company, but maybe bringing in a strong production person, maybe bringing in a strong marketing person. The idea is to be able to add value over and above just giving them a check. So operating capability is one way of doing it. Secondly, a lot of firms, and especially some of my colleagues sitting at the panel here, are part of global teams. So maybe putting your investing companies in touch with potential clients, helping the investing companies source key manpower, absolutely critical. One of the things we're finding a big issue in India, and I'm sure my colleagues will also find that as a challenge, is that you have a really talented entrepreneur. You back the talented entrepreneur. He's done a great job in starting the business and bringing it up to the stage that it is today. But then taking it to the next stage of growth requires a different set of skills. And sometimes the entrepreneur who's so brilliant in having brought it to this stage is potentially not the best person to take it to the next stage, and hence bringing in additional capability can be a significant value add. But to your point, Shashank, I think the GP community will have to now start thinking differently and thinking out of the box to come up with creative solutions.
I don't know if any of the other panelists have thoughts on that question.
Yeah, I'll take that first. I think being part of the Tata Group, we decided for our fund consciously that our strength would be on the manufacturing side more than on any other sector. Tatas have a very wide presence. They have over 70 or 80 businesses, different businesses, largely to do with manufacturing. And this is why we are very well entrenched in what we call the ecosystem. So we know how the business cycles work. We know many of the entrepreneurs who were small earlier, today they have grown larger, but how they have behaved at different points of cycle. This becomes very important for a private equity player, because when things are going well, you would get only glowing references for any entrepreneur. But when the chips are down, how did that entrepreneur behave at that point of time? If you can do a diligence on that somehow, you would possibly end up with a better selection of portfolio companies. I'll give you an example which is not related to what I had just said, but something similar. We have an investment which is in the commercial vehicle space, and it is through Tata Motors' own assessments that we knew that last year the commercial vehicle cycle was going to be a very strong cycle in spite of all the other automobile sector not doing so well. So we pushed our portfolio company to increase capacity when their natural inclination was actually to hold back and not have capacity ready. And as a consequence, this year would be a bumper year for them. So some of these things, understanding of the business cycle, getting them the right kind of technology, in some cases getting the right kind of person who can manage the growth, are the things that funds need to do increasingly, other than just simply writing dollars and checks.
I'll just add quickly. I mean, I think, look, we see the three biggest challenges in India for us are, I think corporate governance is a massive issue. And, for all the talk that we have in business schools about, working on governance and the rest, I mean, there's a serious, amount of research that should be done of why, in some of these emerging markets and particularly in India, given this forum, there is a real issue of a moral compass among a whole sect of entrepreneurs, and so we spend a lot of our time screening on, is this a guy that I can actually trust and is going to work with us? We think depth of management teams is the other big issue. So what was described earlier, where you've got one great guy who gets it to a certain scale, you often find that margins are as good as they are because in addition to not spending on pens and paper, he also doesn't want to spend on people. And so convincing an entrepreneur like that, particularly as a minority guy, that he needs to change his depth of his team, that's really going to add value, is a big challenge usually. And I think third, again, this is linked a bit to the first, but a bit different, which is that just the philosophical understanding of what a partnership is and how to work with a private equity firm. And I think, frankly, we as an industry have done a very poor job of advertising what we do. And PE in India is, someone at the dinner last night commented to me, we are often viewed as easy money, and often I'd go as far as saying dumb money. Because capital is a commodity, and I think entrepreneurs see PE as folks that will come and give them, big valuations, big numbers, won't change how things are done. And frankly, I don't really have any intention of letting you change, even if I tell you you'll be on the board or whatever else. So I think we spend a ton of time trying to, frankly screen for that one ideal situation where it's not just growing fast because everything's growing quickly, where it's not just, profitable and has the ability to scale and get to the right size and big market. But is there a guy there that's really going to help us, allow us to be a partner? And often there's the self-selecting, fix that happens there, which is that he likes TA or someone like us because we've got a global platform, because we can help him grow internationally. And that, even for all the good intentions of how much value we could add at companies, I think there's the question of how many are we allowed to really add value at. So that's where, we spend a lot of our time screening.
Great.
Just add one more point, which is as India gains scale in terms of the local investable corpus of these large global funds, we'll find that there's an ecosystem of resources that get built up that add value. So Darius was mentioning people that can get added at the CFO level and various other levels. But to keep that in perspective, I'll give you a TPG example. There are 180 people globally at TPG that manage about $60 billion of capital. India has about $1 billion invested out of that. And supporting the 180 people, there are 200 operating people. So these are folks that are CEOs, ex-CEOs of major companies like Pepsi or Coke or GE, and various sector specialists that come in and help our companies globally. And in addition, there are also what are called field operational resources. These are people who come in, focus on the supply chain aspects, or come in on focusing on sales. So these are specialized skill sets that firms like TPG, KKR, etc. can bring to companies. But with $1 billion invested in India, it's hard to have a operating base which can support a large number of resources. So right now, we fly in folks from Singapore or Hong Kong who come in and do this work. Over time, as this 1 billion becomes 5 billion, we'll find that we'll have an ecosystem which is present in India, which is more accessible, which is there for the entrepreneur to see and use. Right now, all PE firms go into deal situations, and say we will bring in X amount of value add. But I think the number of firms that have operating partners in India is actually very, very few. If you look at these 350 or 500 firms, there are probably 10 or so. Maybe Darius, you have a better sense of it, but very few funds that actually invest in full-time operating people who work directly with the companies. And as that changes over time, I think there will be more receptivity from the companies because then they will see a direct value add. And also, we will see some sort of alpha being generated because these professionals are able to improve the performance of the companies.
So, just to take a step back, 50 billion invested over the last 5 years, 5 to 10 billion in exits, 500 active funds, of which maybe 200 are actually active, and returns that don't really outperform the public markets. So what are the lessons really learned over the last 10, 12 years? What can we say that we did wrong as an industry, and what can we fix?
Yeah. I think, to my mind, as one looks back over the last 10 years and adopts sort of a somewhat critical stance as to how can you do better than you did in the past. I think some stark learnings that come up is of this universe of total 350 or 500 funds that could potentially invest in India, notwithstanding the sort of 160 to 200 that are sort of more active. A lot of these funds had offices, let's say, in Singapore, and through Singapore or Hong Kong invested in 5 or 6 countries. I think that has clearly, I think one of the very critical lessons that has been learned by people is that you can't parachute people in and out. You have to have local teams that have local level connectivity, that have local level sort of pulse of what is happening on the ground in order to make better informed investment decisions. So that is clearly one. The second point, I think, and to my mind, at least personally, that's a big learning, and people learn different things from different experiences. But if you look at what it takes to actually make money from an investment, there are a lot of factors that have to fall into place. But one of the most important is that you have to enter at the right price. If you overpay at the beginning, then all the good value add that you may do still may not yield the results or the returns that you want, and that. I think people are becoming a little bit more disciplined. The increase in the number of funds and hence the competition in the last few years have led to good deals being priced at valuations which really makes it difficult to earn returns. I think there's an increased element of pricing discipline that's coming into the industry. Certainly we've learned this, and learned this sometimes painfully as we look at transactions. And I think thirdly is this whole ability of, once you've put your money into the company, how do you help the entrepreneur to add value? Because now you're on the same side of the table, you're partners in the business. Oftentimes the entrepreneurs may not consider you a partner in the business, but you have to make damn sure he does consider you a partner in the business, because the easy thing is putting your money in. The challenge is really taking your money out with a return. And the best way that the entrepreneurs can actually look at you as being their partner in creating value is if you can demonstrate some value addition. Can you demonstrate it by adding good people? Can you demonstrate by adding one new customer? Sometimes I found that even adding one new customer, and the entrepreneur looks at you in a different light completely, because that's a very tangible, measurable, demonstrable, to the bottom line kind of value addition. So I think some of these things need to be put into play.
Yeah, if I take the ball on that once again, I think the reason returns mimic public market returns is simply because of the number of pipe transactions that got done. So if you invest in public markets, you will get returns which are close to public markets, so there's no surprise there. The second is the fact that greater fool theory can operate only up till a certain limited point. So a lot of returns in this 2006 to 2007 period were being made by one financial investor selling to another financial investor, not necessarily value being created, and that was being shown as track record, whereas the core business operation would not have gone places in that short period of time. And the third thing is at one point of time, the Indian industry, private equity business, was very fascinated by stars. So somebody very big moves out, starts a business of his own. Okay, fine, we will give him a value of whatever, you name it, $100 million is the pre-money value, just because there is this so-called star who's come in. Well, stars are nice, stars are great, but I believe in business models more than stars. And I think the industry also right now is on that side. Business models, cash flow, profitability, and then we will see about the stars. Stars don't make returns, but cash flow does. So that's my take on that.